Our job begins where most advisors stop. Saving money is great, but how do you spend it without risk in retirement? Welcome to Every Day is Saturday with Brad Gotto and Matt Stahl, partners and private wealth managers at Fiat Wealth Management. In this podcast, we aim to broaden your knowledge about the financial world we live in today and make the boring and complex financial decisions fun, informative, and educational. Join us on this journey where Brad and Matt will explore different strategies on how to spend your money without guilt and have peace of mind knowing you are spending it the optimal way in retirement.
You've done it. You're retired. Now you're staring at this pile of money ready to set up your first paycheck. Suddenly it dawns on you that this isn't all of your money. You're going to owe one of the largest debts in your life to the IRS. I'm Matt Stahl. I'm here with my partner, Brad Gotto of Fiat Wealth Management. Welcome to our podcast, Every Day is Saturday, where today we plan to talk about tax planning. So to kick it off, Brad, this seems old hat to us around the office as this is our focus, but tell us about what you found in talking taxes with retirees.
Well, like Matt said, my name is Brad Gotto, and I'm excited to be here talking about this because as Matt just kind of alluded to, this is something that we talk about all day, every day, but it wasn't always the case, right, man? I mean, we weren't trained this way. We started at a big firm and we're trained right out of the CFP manual, but quite frankly, the language we were given is that we can't give tax advice. So
right.
we shied away from it and didn't really dive into the area of educating ourselves, because we were just always kind of scared away from it. And the more that we got into this business and the more clients that we worked with, the more I kind of laughed at that statement that you and I can't give any tax advice. We can't talk about taxes, because when you really stop and think about it, Matt, that's every time we give advice on a dollar of our client's money, whether it's what bucket to put it in, how liquid it should be or not be, or the obvious things, which is what most people think of when they think of an advisor, which is what stock or mutual fund or bond should I be buying? Every one of those pieces of recommendation has a tax impact.
Right?
Because it doesn't matter if you save it in a retirement account or a non-retirement account, we owe the IRS a bill. And we have to make these decisions if we're going to pay that bill today or if we're going to kick that can down the road to a different day and what that looks like. And so almost as a necessity, we started looking into this whole idea of taxes and tax planning as it relates to pre-retirees and retirees and how we could add value relative to their overall planning process.
Absolutely. As you've said, every investment decision is also a tax decision at the same time.
Yeah. Well, and unfortunately, again, that's lost on most people. You know, every time you choose to put money into a 401k, you're making a tax decision just as you are making an investment decision. And just kind of to flesh that out a little bit, to help people understand what I mean by that. If you choose to put money in a 401k, you're choosing to put it away on a pre-tax basis. Now, to be very clear, pre-tax does not mean you're getting out of taxes. All it means is yeah, right?
What do you mean?
Yeah, all it means is you chose to pay the bill later at a future unknown date, at a future unknown tax rate. And so it's kind of a bet, right? No different than buying into a stock or a bond. And of course, the only reason you would ever do that is because you hope it's going to go up in value and you want to be a winner. And with taxes, anytime you put money away in a pre-tax basis, you're just making the decision, look, I think my tax situation is going to be better at a later date, later in life, whenever that is. That could be 40 years off for you. That could be, 5 years off or next year. But the bottom line is you're not getting out of taxes. You're just choosing to kind of kick that can down the road. And we just want to help people understand that, because as is with everything in life, if you choose not to deal with something today and you choose to procrastinate that till tomorrow or next week or decades later, that can have positive ramifications, but also can have extremely negative ramifications.
So if I retired last week and I am ready to set up my paycheck looking forward to next month, I don't have much time. What's step number one? What's the first thing I do?
Well, for today's podcast, anyway, when we're talking about taxes, the first thing you need to do is delineate how much of the money, the pile of money that you've saved, whatever that dollar amount is. Okay, whether you're a multi-millionaire because of your pile of money or you're not, doesn't really matter, because the tax code does not, it's not gender specific. It's not specific to your tax code's different for you if you have a bigger pile of money or a littler pile of money. The bottom line is there's only 3 tax buckets that exist for all people. There's the pre-tax bucket, which is the 401ks, the IRAs, 403bs, 457 plans, things like that, where you chose not to pay the bill today. Then you've got your after-tax bucket. And this, for a lot of people, this bucket confuses them. But at the end of the day, Matt, this is just, money that you was in your checking account at one point, right? You paid taxes on it. And then you chose, I don't like the 0.02% that my bank gives me, so I'm going to go do something different with it. You invested it, and you're hoping, of course, that it goes up in value. And if it does go up in value, there's still a tax bill, but it's a different tax bill, right? It's capital gains taxation. It's what I call a preferential or preferred tax treatment. And there's a lot of nuance to it that we probably won't get into in today's podcast, but it's different. That's what's important to note, right? Because any money that you pull out of that pre-tax bucket is taxed as income, as you would have had a job, earned income, and you got your check every 2 weeks or once a month, and you look at your check and there's the gross amount you earned. And then of course the government takes their share, your state probably takes its share, and then you net whatever's left. Well, any 401k money works exactly the same way. Then we've got this preferential after-tax bucket. And then there's this last bucket that's a tax-free bucket. And that's money that is same thing, Matt, after-tax money went in. It was checking account money at some point. You chose to invest it, but instead of the growth of that money, hopefully, right? Cross your fingers, the growth of the money, instead of it being taxable at this preferred or preferential rate, there just is no tax bill. And so one of the first things I think people need to do is figure out, okay, of my pile of money, to get back to your question, how much of it is in this bucket where every dollar I pull out is going to be taxed as if I just earned that dollar today? How much of it's in the bucket where I've already paid taxes on the money I invested, but the growth, I have to worry about possible tax impacts at these preferential rates or capital gains rates? And then how much of my money is sitting in this after-tax bucket that grows tax-free? And is there things I should be cognizant of relative to how much money to pull out of each bucket and why?
Has anyone ever told you like buckets a lot?
Well, you got to keep things simple, right? And if there's anything that's not true about the tax code, it's simplicity. And every time it feels like you kind of get it figured out, all they do is change it. In fact, I would argue that's the only consistency with the tax code is change. If you are working and you're W-2'd and you work for another company, and so you're getting that paycheck every 2 weeks or once a month, and maybe you're married and your spouse also has kind of that W-2 income, that's about as simple as tax life gets, honestly, outside of just being a kid and not having any income. And then you get to the stage of retirement where the complexity just goes through the roof, because now it's not, here's your paycheck every 2 weeks, or here's your monthly paycheck, and we're going to automatically withhold taxes for you based on kind of your run rate of income, right? If you're paid it twice a month, that's 24 checks. They kind of are smart enough to be able to extrapolate that out, figure out what your annual income is going to be, reverse engineer that into how much should be withheld with taxes from on your taxes, based on exemptions and things like that. And so they kind of take care of it for you, right? But then you get to retirement, you have this massive pile of money, hopefully, relative to what it's been in the past. For sure, for most people, the pile of money is bigger the day you retire than it's ever been. But regardless of whatever that number is, you now have the onus is on you to figure out how to pay the tax bill. And when you think about it, Matt, the way I kind of envision this is, can you imagine being 22 years old? You get your first job and you get out of college and your salary is $50,000 a year, right? And so over the next 40 years, you're going to earn a couple $1 million, assuming you don't get any pay raises. Just keep my story simple. Can you imagine being 22 and your employer hands you your income for the next 40 years, right then and there, hands you that check for $2 million?
I'm not sure that would have been a good idea.
Yeah, well, especially since we're male, right? Our frontal lobe's not even developed until we're 25, I think. So, but a lot of problems with that. Obviously, not running out of money would be a huge problem. But then you and I trying to figure out, well, I don't know how much of this I've part of it I owed Uncle Sam, but what does that look like? And it's kind of a daunting thought process.
So you mentioned earlier about thinking about kicking the can down the road. Is there a time when it makes sense to defer paying taxes? You said I'm never going to get out of them. So at what times would it make sense to kick that can down the road?
Yeah, it's a great question. And the politician answer is sometimes it makes sense to do it and sometimes it doesn't.
Oh, come on.
Yeah, right. Everybody's situation is different. We'll never get this approved through compliance if I give you specific advice. So that said, it's just true, because taxes are one of those goofy things where if you have a bunch of money you've never paid the tax bill on, in other words, you've got 401k money and IRA money or similar type accounts, the question, Matt, is not, do I have to pay taxes? Because you do. Absolutely, unequivocally, as the code is written today, you owe the government taxes on that pile of money. And so I actually got into a little bit of an exchange with a gentleman about this once. He attended one of our tax workshops that we do here in the Twin Cities. And he kept telling me, he's like, Brad, I got $2 million in my IRA. And when you do the math, I've got plenty of money to live on. And I said, well, the problem is you're not taking into account the fact that you don't actually have $2 million. And he's like, well, yes, I do. I can show you my statements. And I said, yeah, but you're not taking into account the IRS. You have not paid the IRS off on that pile of money yet. And so you have something less than that. But here's the hardest part in that is, how much does he owe the IRS? Well, it's not a set answer. It depends on how much he pulls out, when he pulls it out, what the tax rates are at that time, and then what other monies does he have coming in the door to supplement that are also going to hit his tax return at the same time that he's taking distributions from his 401k or his IRA. So as an example, Matt, something like, is your Social Security turned on yet or not? Because depending on some other situations, for most people in retirement, your Social Security is taxable. Not for everybody. If you're unfamiliar, there are ways to get your Social Security tax-free. Do they have a pension coming in the door, or do they not? If they're married, does their spouse have these types of income coming in the door? Are they also taking distribution from after-tax accounts? So they have dividends coming off of stocks and things like that matter to their taxes. There could be a lot of different things going on that kind of create the paycheck. I always like to kind of give the example that if you think about like your working years, most people have one job, maybe two jobs, but it's easy to keep track of, right? Because it's just kind of one source of income's kind of funding everything in your life. And then you get to retirement and it's almost like you have 6 jobs because you got all these little paychecks coming in that together create the lifestyle that you want. But some of it comes from Social Security. Some of it might come from a pension. Some of it might come from IRAs, like traditional IRAs. Some of it might be coming from deferred comp, some from Roth, some from your checking account. And all of those hit your 1040 differently. And sometimes what we see is it hits the person's 1040 and they have, no idea how it's all going to kind of play out. And they end up with a lot bigger tax bill than they thought they were going to. So for some people, Matt, it can make sense. Hey, based on these other things you got going on in your life, we should continue to kick that can down the road. Let's not pull 401k money right now, okay, or IRA money, because there's reasons where if we defer this out without a lot of guesswork, we can see that your bill is going to go down in the future. So let's pay the bill when it's cheaper. Okay. Or for other people, it's the exact opposite. It's like, look, your bill is just going to continue to go up based on your set of circumstances. And so I know the IRS isn't going to force you to pay that bill right now. In other words, they're not going to make you take it out of your IRA or your 401k, but you can if you want to. And because the IRS's bill is less today, let's just do it today. I mean, why are we waiting until we know the IRS is going to increase your bill down the line?
So looking at the tax planning side of things, is there a moment, why and when, and I want to hear your answer, did we decide to focus on tax planning?
Just because it was so overlooked when it came to the planning side of things, as we continued to interact, Matt, with people because most of the people that interact with our firm come to our firm having an existing relationship with a financial advisor, or in the past have had multiple relationships with financial advisors. And Matt, maybe your number is going to be different than mine, but I think probably it's definitely over 90% of people, wouldn't you say, that have experience with our industry? And my experience has been, and again, you can give your number, but my experience has been less than 10% of those people are getting any sort of help when it comes to kind of a distribution strategy for their money, or what we like to call internally an IRA exit strategy, and trying to figure out the cheapest way to pay off the IRS into the future. Would you agree?
I would agree. Same pattern that I observed is often we'd have the conversation. I have an investment advisor and I have a CPA, so I don't think I need to do any more tax planning. And the further we dig into that, we'd realize, wait a second, our investment advisor over here and our CPA aren't talking to each other. Usually the CPA is looking back over the past year, and that's not to say there's anything wrong with that. But we found that the investment advisor wasn't necessarily looking forward into the next year. That's where I see we really filled that gap.
Yeah, well, it's like anything in life, Matt. Anytime you can kind of kick a can down the road, a lot of times we like to do it. Why? It's that old saying of why procrastinate till tomorrow, what you can procrastinate till next week, right?
Right.
And if you think about the idea of being a CPA and the guy that files taxes, whether you're an H&R Block person or you're filing your own taxes through TurboTax, or you have an independent CPA that you work with, their job in essence, and I don't fault them for this, but is to figure out how to minimize your tax bill today. Right.
Yep.
And so they're always looking at, okay, what can I do to save, this particular client the most I can on taxes in 2020 or 2021 or whatever it may be. And quite frankly, what ends up happening a lot of times for people is they make decisions today that can feel really good today and may actually decrease their taxes today, but they're actually dramatically increasing their tax bill in the future. And so we like to look at it from that big picture approach, kind of begin with the end in mind and say, okay, you're not retiring and going to spend all of your money today. We got to figure out how to kind of stretch this out over whatever life expectancy you have. And knowing that, and knowing where the tax code exists today, knowing, like as an example, Matt, we talk about it all the time. We're in the middle of this little Tax Cuts and Job Act that was passed in 2018, and for all intents and purposes, put taxes on sale for the vast majority of Americans. And so if that's the case, and you're sitting on this big pile of money that you've never paid taxes on, well, wouldn't it stand to reason that we might want to start paying some of that tax bill off now while taxes are on sale, relative to what we know they're going to be when the Tax Cuts and Job Act expires? Because like any good sale, Matt, whether it's at Target or at the IRS, it's not permanent. It goes away. And so when these rates come back to the pre-Tax Cuts and Job Act levels, most people, not all of them, but most people's bills are going to go up. And so if we begin with the end in mind, big picture, look at the totality of your retirement and figure out how to minimize the IRS in your life, not just for today, but for today, 5 years from now, 10 years from now, and 20 years from now, it can have a huge impact on the overall value, or really, I guess the better way to say that, Matt, would be how much of your money you actually get to keep. Because unlike most mortgages these days, the IRS's bill is not a fixed rate. Because when you think about like debt, like I owe the IRS a bunch of money, it's kind of like having debt, right? Except it's not a fixed debt amount, right? You can't look at somebody with $1 million in an IRA and look at 5 other people with $1 million in an IRA and know that all of them owe the IRS the same amount of money, because they don't. In fact, probably, Matt, they're all different. Not only are they different, but they're probably dramatically different. It's one of those things where unless you have a proactive approach to figuring out how to basically kind of control your taxes in retirement, it can get really inefficient really quick. And quite frankly, the IRS can be a much bigger part of your life than you want it to be while you're alive, let alone, if you're so inclined to leave any of it behind for the next generation, can become one of your largest benefactors of your estate.
Okay. What would you say the biggest mistakes or faulty thinking that you see when we're talking to retirees about tax planning?
I don't know that they say this explicitly, Matt, but I think what comes through is because when we start having these conversations with people, sometimes they look at us like we have a third eye, right? Because we're kind of going against the grain of maybe what they've been told their entire life. And part of that is just because they're in a different phase of life. And so it stands to reason that, if you're entering into retirement or near it, or you're already in it and been in it for 5 years, the things that you need to be doing are probably different than the things you're going to be doing to get yourself there. So that's part of it. But I really do believe most people think they're getting out of taxes in their IRAs and their 401ks.
You mean they're not?
Yeah, right. We've from the Department of Redundancy Department, you have to pay your tax bill. And just because you deferred it doesn't mean you get out of it. And so the misnomer that comes with that, when we start having these conversations with these people of, hey, maybe we should start pulling money out of your IRA today, because if we do it today, your bill is going to be this at this known rate. And we think that's cheap relative to where things are going in the future and where they've been in the past and all these things. The standard response we get, Matt, and this is, well, I don't need the money. To which I respond the same all the time. Well, okay, perfect. That's fine. Because although anytime you pull money out of an IRA or 401k, it's considered income from a tax perspective, income does not mean spend. Now we live in the United States. And so it's hard to fathom. Chief assistanters here, by the way, love to spend money. But just because you pull the money out of the IRA, Matt, does not mean you automatically have to put that into cash flow and go spend it or buy a new car. In fact, we can resave the money, and we could, if we wanted to, Matt, buy the exact same investments, right? And so it's not an investment decision. So we pull it out of the IRA in ABC mutual fund, and we can put it into an after-tax IRA and rebuy ABC mutual fund. And all we did, for all intents and purposes, was during that transaction is paid off the IRS and said, from this day forward, I want to be off the grid with this pile of money. I'm going to pay you off now. I'm going to prepay you. And then that way, this money from now into perpetuity is off the grid. And I can use that down the line as I see fit, and it will not have an impact or a bearing on my overall tax bill at the end of the year.
All right. Brad, would you like to share with everyone how they could best reach out to us?
Yeah, the easiest way is our website. Whether you want to call the firm, email anybody in the firm, or find us on social media, look up all of our marketing events, everything that we do from a contact perspective is on our website, www.fiatwm.com. So check us out there. There's actually some fun videos out there as well about kind of this tax planning that we do for our clients and our prospective clients. And guys, as always, please subscribe to the podcast if you haven't already so that you don't miss an episode. We would love it if you would share it with your friends and your loved ones, because who doesn't want to listen to podcasts about taxes? I mean, come on. This is the most interesting content ever. And with that said, you guys, thanks for tuning in today. I'm Brad Gotto.
And I'm Matt Stahl.
And we'll see you next Saturday.
But Brad, we don't release the podcast on Saturday.
But Matt, every day is Saturday.
Thank you for listening to Every Day is Saturday. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Fiat Wealth Management or Foundation's investment advisors. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.